Hello and welcome to the week ahead for July the 14th with me, Fiona Cincotta, Senior Market Analyst at City Index. So just before we get going, I'm just going to ask you to have a quick read through the risk warning. I'll put myself on mute for a few moments whilst you Okay, so let's get going. Let's just start by a quick look at what's going on in the markets across this week. We have in fact seen US indices, the NASDAQ, the S&P 500 reach record highs. And yet that despite quite a few announcements and developments as far as Trump's trade tariffs are concerned, we even saw a recovery in the US dollar off the 3.5-month low. So we had from Trump, we had the announcements of a 50% tariff on copper. He also sent out 14 letters to different countries, followed by 7 letters to other countries informing them of trade tariffs. Just today, he announced a 35% tariff on Canada and is potentially weighing up the idea of a 15% universal tariff rather than 10%. Yet despite all of that information, which is negative as far as, you know, the impact that it's going to have potentially, the start date for those tariffs was pushed back to August the 1st. So there is a sense that the market is saying, well, you know, there is still room for pushing back, pedaling back, renegotiating. It doesn't feel like as dramatic as obviously it was in Trump's Liberation Day tariffs. The market seems to be taking this all much more with a big pinch of salt, which, you know, if we think about where we are, we're trading at record highs, and yet there is a potential large risk facing the US economy and the global economy. So it does feel that perhaps investors aren't necessarily pricing in these risks to the level that perhaps they're in seeing. We're seeing this a little bit more maybe in the bond market, in the US dollar, but less in the stock market. And I mean, I think there's a potential that we may see more of a reaction when data actually starts coming through showing the impact that these trade tariffs are having, if they do have this expected impact of increased inflation and slower growth, and we start to see that, then we might see the reaction in the market. But also we've got earnings season next week, so maybe sort of, you know, any sort of comments from corporates over what the outlook is, or whether we get sort of, you know, more depressed outlooks, then I think that could impact market sentiment as well. But all in all, given everything that's been announced this week, the market's held up phenomenally well. So just as far as technicals are concerned, this is the S&P 500. We broke out of this rising channel that was just at the beginning or the end of June, rose up to a fresh record high there of 62.90 yesterday, so just within a breath of the 6300 level. Has just eased back. We're still above that rising trend line, but I mean, it's going to take quite a significant, you know, fall towards the 6,000 level to really negate that near-term uptrend that we're looking at. Also, it's worth noting that, you know, we have seen that the RSI was a little bit on the overbought side, so it was looking a little bit overstretched. So, you know, the sell-off that we're seeing today, Friday, still doesn't really make up for the fact that we're up at those record levels. So just as far as data is concerned next week, I mean, this week was a quiet week as far as data is concerned. Next week, we've got US inflation, that's the big one. We've also got US retail sales, PPI, and Michigan consumer sentiment. So just starting off with US inflation. Now, I think inflation in the US does appear to be showing signs of easing. It's sort of, although that cooling impact is slowing, I think the ISM services, the prices paid components, they're still showing signs of stickiness. But the May CPI, that's eased to, actually it ticked higher to 2.4%, up from 2.3%, whilst the core prices remained unchanged at 2.8%, so a little bit stickier. They've remained at 2.8% for the last 3 months. Now, we've seen this resilience in the job market. I mean, you know, jobless claims this week came in a 7-week low, suggesting that, you know, market conditions are providing the Federal Reserve the luxury of remaining cautious with regards to cutting interest rates further. So they really do have, you know, as the jobs market is holding up, as inflation is, you know, it's still a little bit above the 2% target level, but it's still down from 3% at the start of the year. So, you know, it's at a level where the Fed can continue with this wait and see mood to see what the impact of the US tariffs are on inflation. Now, if we do get cooler than expected inflation, this could actually give the stock markets a boost. That could add to expectations of Fed rate cuts, and that would be good news for stocks. However, if we get hotter than expected inflation, that could be starting to sound the warning bells, particularly if it's a significant move higher. That could start to sound warning bells that inflationary impacts are coming because of Trump's trade tariffs. So let's just take a quick look also at the Dow Jones whilst we're here. Not quite at record highs. Here we go. It's trading in this sort of relatively familiar level, above the 44,000, but below the 45,000. Seen a little bit of consolidation around here, which has brought the RSI back out of overbought territory. So we got to a high of 44,880. That was last week. Since then, we've had a little bit of a slip lower and a recovery. But if we get weaker than expected inflation data, then I think we can expect to see sort of a test of this 44,000 level, just because it could spark those concerns over what the impact of Trump's trade tariffs. I'm just going to bring up the dollar here. As we can see, I mean, we've picked up from that low there of 96.94, recovered, bringing the RSI out of overbought. Look, we've got that little bit of a longer wick on that particular candle. Testing here the falling trend line, so we're actually at quite an important inflection point. We've got the low here, which is the low from April, and then we've also got the falling trend line support there, and we're also just testing the resistance, and we're testing the 20 SMA as well. So if we actually get a close above this level, which would be fairly significant, just to confirm what that level is, 98 level. If we get a confirm above, close above there, then potentially we could start to see bulls move towards the 99 level. So that's the US dollar again. So as I said, if we get weaker than expected inflation data, we could see the US dollar come off. It does feel that the US dollar has recovered, and again, you know, this seems to be in line with the recovery in stocks that we've seen, that the wholesale America trade has eased a little bit. So that's that data. Now we've also got UK figures coming through this week. We've got inflation data, and we've also got the jobs data. So inflation in the UK, basically it eased to 3.4% in the previous month, and that's after it had jumped to 3.5% in April. Now, the 3.4% was slightly ahead of expectations of 3.3%, but service sector inflation, which is an element that the Bank of England does watch quite closely, actually caused by more than expected to 4.7%, down from 5.4%. Although this is still high, it's too high to be cutting any interest rates aggressively, with service sector inflation still at those levels. Now, service sector inflation is intrinsically linked to wage growth. That's worth keeping in mind. So we'd need to see wage growth cool in order for service sector inflation to show signs of cooling as well. Interesting though, food inflation is edging up again. That rose 1% to 4.4% in April, up from 3.4%. And I mean, overall, though, I would say the data continues to suggest that inflation is moving in the right direction, albeit slowly. And it just supports the view that the Bank of England will continue to cut rates at that gradual pace that they said they would be cutting rates at, carefully and gradually. Now, we've also got the wage growth and unemployment. Now, the impact of the government's budget, where it increased the tax burden on employers, is starting to feed through into jobs numbers. Basically, we've seen that the unemployment rate ticked higher to 4.6%, marking the highest level since 2020. And this is basically because it's more expensive for companies to employ people because of that increased tax burden. Now, since that budget was announced with that increased tax burden, we've seen unemployment rise from 4% to 4.6%. So the slowdown in hiring appears to be accelerating, with industry data supporting that view, as well as falling payrolls. I mean, according to Statista, payrolls have been on the decline each month since November last year. Now, a weaker labour market means weaker wage growth, so that could also accelerate a contraction in GDP data. Let's not forget, today we saw UK GDP unexpectedly contracted for a second straight month, so it fell 0.1%. It was expected to actually rise by 1.2%. So that was a surprise, and not a pleasant surprise for the Chancellor of the Exchequer, who is obviously needing some growth before the autumn budget. So anyway, back to inflation, wage growth. If we get more signs of the UK jobs labour market weakening, then we could actually see a continued weakening in sterling US dollar. We've obviously seen that dollar recovery as well. That peak was in there at 137.90, broken below the rising channel, which dates back to the start of the year. We're about to test the 50 SMA, which is at the 135 level. If we get a break below that, 134.50, is we could see a much deeper sell-off come into view. On the upside, if we get hotter than expected inflation, stronger jobs data, then on the upside, looking for a rise above here first. That's the 136 level. Above there, we get 137 coming into focus ahead of the 138 multi-year high that we saw at the beginning of July. So that's FTSE. Let's just have a look. Sorry, that was sterling. Let's just have a look at what is going on as far as the FTSE is concerned. So that's trading at record highs. I'm just going to put it up in the 4-hour chart, because I think it's a better chart to be looking at. It just gives us a little bit more insight. So in the 4-hour chart, we were trading in this rising trend line, broke out, rose up to 89.90, so just below the 90,000, and we have come lower. Long lower wick on this chart is suggests that there was little selling pressure at those lower levels, but as far as support is concerned, the 8,900 is the levels we're watching out for. As long as we remain above that level, then things are looking still positive for the pair. A rise above 9,000 is what buyers will be looking to do to extend the gains. On the downside, it would take a fall below this level here, 88.50, to create a lower low. So that is the FTSE. We've done US data, we've got US inflation data, and we've got also, we'll come on to earnings season in a minute, but we've just got Chinese GDP as well. Sorry, my spelling. Huh? Okay, so having a quick look here at the Hang Seng. So again, we've had quite a bit of volatility in this pair, obviously. Now we've had China is going to be publishing the main bulk of its key economic indicators for June. On Monday, we've got the trade data, which is expected to show a slight uptick in exports and import growth on the month, but there hasn't really been much front loading of activity during the tariff ceasefire. But then on Tuesday, the main focus is going to be here on the GDP data, Q2 GDP, which is expected to confirm the 5% year-on-year growth. And that's sort of in line with full year forecasts, the full year target. But I think, you know, there is a potential to see some weakness, and any weakness actually could impact market sentiment, but also fuel expectations of further fiscal stimulus. Now, the Chinese economy is expected to come under pressure from external challenges across the second half of this year, and achieving that full year growth of 5%, I think, is likely to be challenging and therefore could require more targeted policy measures. So any sense that there's more policy measures coming could give the Hang Seng a boost. We just have a look at what's going on here. I mean, we've been tracking the 200 SMA. Sorry, this is the 4-hour chart, isn't it? Let me just take this out. But it's been tracking that 4-hour chart really nicely. Here we go. So we've got this uptrend, this V-shaped recovery that we've been experiencing from those lows in April. The price did hit 24,500 briefly today before falling back lower. So there doesn't tend to be too much demand at those upper levels. Just watching to see whether we've got a double top formation there. But on the way down, we're just testing now the 20 SMA. If we get a break below there, watching out here for 23,650. That's sort of like the low of July, as well as the 50 SMA below here, 23,000 comes into play. So these are the levels to be watching. On the upside, you need to get a break above the 24,500 in order to be creating a higher high. Now, I just think it's worth having a quick look at what's going on with gold as well, particularly given that all this uncertainty that there is still flying around as far as trade tariffs are concerned. I mean, gold is actually consolidating. It's in consolidation mode. You know, we were in this smaller rising channel here, but it's actually broken out of the channel, but hasn't done too much with that breakout. Still holding above the 3,300 level, hasn't managed to break anywhere near the upside of that 3,400 level. So we're just caught between these two levels at the moment, 3,300 and 3,400 in a neutral. RSI is broadly neutral as well. Just feels like the gold market is a little bit of wait and see to see what the impact of these tariffs is going to be on economic data. As I was saying, don't really seem to have had a massive reaction to the data this week, which was far from positive as far as trade is concerned. So also what we're going to be watching out for next week is earnings season. So we've got Netflix, well, banks kick off earnings season. So we had a look already at US S&P 500, but let's just put it up again. Banks will be kicking off earnings season on the 15th of July. So that's Tuesday. We've got JP Morgan, Wells Fargo, and Citigroup. That's followed by Goldman Sachs and Morgan Stanley on the Wednesday. Now, these earnings come after we have actually seen some solid share price performance for the major banks across the second quarter, rising to record highs. And US banks basically delivered strong first quarter earnings, beating forecasts. And this was driven by impressive trading desk numbers, which have sort of really driven the standout performance due to the volatile market. Investment banking and lending activity also remains solid. Looking to Q2, I think there's increased headwinds from macroeconomic uncertainty owing to Trump's trade tariffs. Now, if we think about it, we kicked off Q2 with the announcement of Liberation Day tariffs, which were then paused. Now, volatile market conditions are great for the banks, but because then we can expect to see a strong performance on the trading desks again. But I think broadly speaking, the earnings outlook is a little bit more subdued, just concerns over growth, weaker demand in investment banking and the conventional banking businesses. It's also worth noting that despite sort of, anemic earnings outlooks, the share price did actually shoot higher across the quarter. And I think that's a lot to do with these banks comfortably passing the Federal Reserve stress test, which has opened the door for increased capital returns and shareholder buybacks. So strong data going to be helping the S&P 500 push higher. Just also having a look, we've got Netflix. Let's have a look at the S&P, the NASDAQ. This is the NASDAQ. So Netflix will also be releasing numbers this week. Now, this is obviously a company that has proved itself to be the world's #1 streaming network. It has beaten off competition left, right, and center. And the share price in Netflix is trading around record highs, and that was after impressive Q1 update. Headline numbers came in ahead of expectations. Net income was at $2.89 billion up from 2.44 forecast. Operating margins jumped to 31.7%, well above the 28% forecast. And the revenue was 10.5 billion. So we've got Q2 revenue as forecast at 11 billion. Net income is expected to rise to 3.05 billion, and operating margins rise to 3.3%. So this is the NASDAQ that we're looking at, similar to what we've seen as far as S&P is concerned, breaking out of this rising trend line. Didn't quite make it to the 2300 level, but did make it to 22867, fresh all-time highs. 22,900, so fresh all-time highs. And we're just having a bit of consolidation at this level, not surprising given that we had tipped into overbought territory. There's nothing here at the moment pointing to a correction. There is a sense maybe momentum could be slowing, but as the RSI is pointing downwards, but then we've got this consolidation pattern. So there's nothing here yet which is telling us of a reversal to be, but it's worth watching your eyes out given the fundamental backdrop and the fact that we're heading into earnings season. We've got quite a few risk factors and also low liquidity, low volumes because of these summer months. Now, we don't seem to have much data out as far as Europe is concerned. Just going to bring a quick look at the DAX, given that it rose to record highs yesterday, has fallen away. We're just also waiting for next week, really. Could be before then, but the update from the US over the trading tariffs for the EU. Germany is obviously a big exporter of cars to the EU, so it's going to be very key for that industry as well as pharmaceuticals as to what happens. We're back below the 24,450 support, which is now turned into resistance on the back of these sort of universal tariff announcements. But still, in the grand scheme of things, we're still heading higher. The downtrend hasn't been broken. We'd need to sort of see a move below around the 2400 level to negate that near-term runoff. But I mean, it's not until 23,000 that we would see a lower low. Just finally, we'll take a quick look at oil. I mean, after oil's calmed down considerably after the as the Middle East tensions in the Middle East have eased, we have obviously seen that increase in output. It's not necessarily going to be relating across to increase in output on the ground, which is why I think we haven't really seen the oil price fall considerably. But interestingly, it hasn't made it back over the 200 SMA this week, and that's at around the 68.30 level. The price has very much been rejected. Still rising on the north-facing rising trend line, but not so far being able to get about that across that 68.20 level, which is needed to bring 70 into focus. On the downside, we do have this support there around the 66.30 level, which is the rising trend line. Below that, look out for sort of around the 65 level support, and on to 60 if we fall below there. So that is everything from me. I think we've pretty much covered a lot of what's going on next week, as well as touching on themes. So thanks very much for your time, and I'll see you next week.